Hi there, welcome to Kneppy Invest. Time for a bit of an update to a company called Dropsuite. This is a company I have been following for a few years now, and it is a sort of company you can be patient on right now because the share price has been going sideways, and that will become quite obvious when we look at the chart, the 1-year daily chart towards the end of this video. However, Dropsuite continues to grow. So even though the share price is consolidating, I think this company becomes more and more interesting, particularly because Dropsuite is operating cash flow positive. And if they can find a little bit more scale over the next few years, this company, it becomes even more interesting. So in today's video, we're going to focus on Dropsuite's Appendix 4C for the June quarter in financial year 22. Dropsuite provide backup, archiving, and recovery solutions. Now, they do partner with MSPs who then bundle Dropsuite's products to their end customers. And the end customers typically are SMB, so small to medium-sized businesses with about 20 to 200 people that don't really have the IT infrastructure to be able to handle these sort of solutions that Dropsuite provides. So we're talking about Office 365. Workspace, Gmail, all those small things you wouldn't think need to be backed up, archived, and able to be recovered. And the reason this is important is because of the digital transformation we're going through, cybersecurity, and also regulation. And it's really interesting. If you actually do go to the Microsoft website, and the terms of service says that they recommend that you regularly back up your content and data that you store on the services or store using third-party apps and services, and they're not responsible for any loss. So this is why Dropsuite is quite important to be able to back up, archive, and recover your data. Now to some facts in regards to Dropsuite. Company was founded in 2011 and listed on the ASX in December 2016. It was a backdoor listing via Excalibur Mining, and that was via GoldQuest, which listed on the ASX back in 1983. So if you actually do go to some websites, they will say Dropsuite has been on the ASX since 1983. No, it's just backdoor listing. It hasn't been in existence for about 40 years. Yeah, 1983 is 40 years ago. Wow. Anyway, the CEO is Sharif El Ansari. He has a 4.9% stake in the company. So a nice skin in the game. And I do like companies with management who have skin in the game because their interests are aligned with shareholders' interests. So that is a key point in regards to these sort of companies. You want to see a little bit of skin in the game, in my opinion. Not too much, but just a little bit. And one of the biggest shareholders is Topline Capital Management. They have 11.6% stake in the capital. I've already mentioned the share price has done absolutely nothing over the past year. And in fact, if you go back to January 2022, the market cap of Dropsuite was $140 million. That's a share price of 20.5 cents. That's the last time I did a video on Dropsuite. And at that point in time, the company looked interesting. The company still looks interesting, but the market cap, the valuation of this company has gone sideways. So at a share price of 21 cents, the market cap is 143 million. Now, day to day, the share price can be a little bit volatility because there is a little bit of illiquidity problems with this company, but generally the share price does go sideways. So maybe if you can buy this company at a share price, say 17, 18 cents, if it does fall there, if some shareholder decides to just dump their shares on one day, that would be ideal position or ideal share price to take a position in this company. And Dropsuite has a ticker code DSE. Now on to looking at the Appendix 4C for Dropsuite. And before we have a look at the financial year 22 June quarter, let's just go back 1 year ago. Have a look at the June quarter for financial year 21. I just want to see how this company has progressed over the past year. Is it still growing? Is receipts growing with time? That is very important for me. I want to see receipts or revenue growing at a consistent rate through time. So in the June quarter for financial year 21, Dropsuite had receipts for customers to the tune of 2.4 million, and they were barely operating cash flow negative by $21,000. So we'll call that operating cash flow neutral. And because this company doesn't spend much money in financing and investing activities, the cash on hand actually was sideways for the quarter and finished at $2.4 million. Now, Dropsuite did do a couple of raising over the past year, and that's why the cash on hand has increased by a lot. So the company hasn't produced a lot of cash say $17 million of cash in operations, it's because of that capital raising. So let's see how the company has progressed over the past year. Receipts up $1.9 million, so almost doubled, and that is good growth. So receipts up to $4.3 million, and now the company is operating cash flow positive to the tune of $470,000. So product manufacturing operating costs up $1 million, staff costs up $500,000, administration costs actually down. So this company does have a control on their costs, and receipts are growing at a quicker rate than their spending. So this company is finding a little bit of scale, but it's slowly getting there, as you can see by this last quarter. Now, over the first 6 months of their financial year 22, the company was operating cash flow negative by $111,000. So they're not operating cash flow positive on a continual basis. So if you look at each quarter, this company still hasn't quite achieved that really important inflection point. And that important inflection point is being operating cash flow positive on a consistent basis. So they haven't quite got there yet, but I think this company will be able to achieve that. And again, just like 1 year ago, this company doesn't spend much money on financing and investing activities. And that means that $407,000, majority of that fell to the bottom line. And that's why the cash on hand actually increased in this current quarter. Now onto the receipts history for Dropsuite. And this is very important because I want to see receipts growing at a pretty good rate over time. I don't want to see receipts going sideways or down because that's negative. And the reason I look at receipts growth or revenue growth is the best way to grow the company over the long term is to grow your revenue. You can't grow your company consistently over time by decreasing your costs if receipts and revenue aren't growing. That is a way a companies are able to grow over the very short term is to decrease their costs, but it's not a long-term strategy. So that's one of the reasons why I always focus on receipts or revenue growth. And for Dropsuite, there is no doubt receipts and the revenue is growing through time. So if we take a look at the receipts history for Dropsuite going back to the March quarter of 2017, we have seen really good growth in the receipts. In fact, receipts have grown from $340,000 to $4.3 million. And there is a consistent growth almost quarter on quarter here, particularly over the past 2 years. In fact, receipts have grown from 1.1 million to 4.3 million. There was a period back in 2018 to 2020 where it didn't look like receipts were growing. So receipts were going sideways. So there were some troubling aspects to Dropsuite back then. But definitely over the past 2 years, receipts have moved into a really well-defined uptrend. Now, to be fair, you don't really have to track Dropsuite's growth in receipts on a quarterly basis because the company does provide unrecurring revenue information in their commentary of the Appendix 4Cs. And in this particular slide, I'm looking at the annual recurring revenue they provided in last year's June quarter to this year's June quarter on the right. So 1 year ago, the annual recurring revenue was at $11 million. Now it's up to $20.1 million. So there's really good growth in there in annual recurring revenue. In fact, it's almost doubled. However, in saying that, they have slightly changed at how they look at annual recurring revenue. So in this particular quarter, they're looking at constant currency. They weren't doing that last year. So that's one little slight bugbear I do have on what Dropsuite have provided here. They're not looking like to like. There is a slight difference in what they're looking at, but that's a very small little problem I do have. It's nothing too major because the main theme here is that annual recurring revenue is growing quite nicely through time. Another thing the company provides in their commentary is this quarterly normalized operation cash flow graph or table here. So the company's management is focused on becoming operating cash flow positive on a consistent basis. And this is really important for me because this actually shows me that the management's, their interests are aligned with my interests. I want to see this company becoming operating cash flow positive on a consistent basis. And for the simple fact they provided this in their commentary tells me that they are interested in becoming operating cash flow positive, free cash flow positive, and profitable. Now, why am I saying that? Shouldn't this be obvious that most management teams for companies are focused on this? Not true. There are some companies out there, some management of some companies out there who don't really care about profitability. profitability. And that is a problem, in my opinion, moving forward, because the best way to value a company is to look at their, or get a present value of their future cash flows. And if a company has no path to profitability, then the value of that company has to be zero. Now onto the chart for Dropsuite, and this is the daily chart for the company going back 1 year. If you look at the longer term chart, which I'm not going to provide you in this video, the share price is in an uptrend. However, the share price has been consolidating over the past year. There is a little bit of volatility here when you're looking at the very short term. So for instance, back in October, the share price did look like it might be breaking out. Share price reached a high of 28.5 cents, but then pulled back. And the share price low is 15 cents. And that share price was reached during that major weakness we saw in the markets during June. That would have been an ideal time maybe to take a position in this company, and the share price has bounced since then, just like many other companies on the ASX. But if you look at the share price 1 year ago to the share price now, the share price is going sideways. The share price is consolidating. So what I'm looking out for with Dropsuite in the future is a breakout to the share price to the upside on higher volume. Ideally, that breakout in the share price would coincide with some really positive financial news from the company. Overall, I am fairly bullish on Dropsuite moving forward, just because we're seeing really good growth in the unrecurring revenue. The company is operating cash flow positive. I'd like to see that on a quarter to quarter or quarter by quarter basis. So not every quarter they are operating cash flow positive, but I think the future is bright for this company. Now, in their space, in this backup archiving space, there's a lot of competition. So that is one risk moving forward. And I don't know Dropsuite enough to know what sort of competitive advantage they have over their competition. That's all I have for this look at Dropsuite's Appendix 4C for their June quarter in financial year 22. It's looking good for the company itself. Nice growth in their unrecurring revenue. The company is now operating cash flow positive. Maybe not on a consistent basis. That's one thing I'd like to see. That will be a very important inflection point. However, the share price is just going sideways. So no well-defined uptrend in the share price. But in saying that, I think if you do see a little bit of a weakness in the share price, if the share price pulls back to say 15 cents again, that could be a good opportunity to buy this. We won't say it's a good quality company. We'll call this a potentially good quality company in the next 5 years. And if this company does prove that it is a good quality company in terms of profitability, I think a valuation of 140 million would look quite cheap. So they will have to prove that to us, to me, but I am looking out for a bit of a breakout in the share price if they can start proving that. And I think if they do start proving that to the market, the share price will move into that uptrend. If you do have any questions, any thoughts about this company, just leave your comments in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.